Good morning, and thank you for joining us. I'm Logan Webb, Chief Investment Officer for Florida Trust Wealth Management. And today I'm joined by Zach Chachinsky in Naples, Florida, and Jody Schwartzel in Sanibel, Fort Myers, Florida. And I'm here in Tampa, where the Tampa Bay Rays are firmly in first place. I just wanted to mention that to the Yankees fans in attendance. But I digress. In markets, the S&P 500 is now bumping up against all-time highs, up 10% midway through the year, on track for its fourth consecutive double-digit year. Volatility is certainly expected as we move forward, but we're cautiously optimistic in terms of where the market's headed from here. The price of oil has collapsed significantly over the last couple of weeks, down from a high of 117 for WTI crude West Texas Intermediate, down to a low of $70 per barrel. And while inflation should remain sticky for the foreseeable future, this does alleviate some of the inflationary pressures that we've been concerned about heading into 2026. So going forward, all eyes are squarely on the Federal Reserve and new Fed Chair Kevin Warsh. An interesting dynamic has unfolded there, where going into this year, it was the expectation that we would see rate cuts throughout 2026. And just recently, thanks to a very strong jobs report, we're now in the environment where good news is bad news. The new expectation is that there may be rate hikes throughout 2026. Now, this is a concern that we're watching somewhat closely as we go into the second half of this year. In our view, we think that the Federal Reserve doesn't necessarily need to do anything at all this year in terms of moving rates. They can allow free markets to operate without interfering and changing the direction of rates from here. So our expectation is that rates should be somewhat range bound and shouldn't move too much from the current levels. But this is a dynamic that we're watching very, very closely. And a lot of the move to the upside in markets has really been driven by extraordinarily strong earnings growth, specifically from the hyperscalers. The capex spend that we've seen from the hyperscalers has been nothing short of extraordinary in the first half of 2026, and that should continue as we go forward. But we're cautiously optimistic that earnings growth will continue, and that's what's going to drive the market higher from here. A caveat, as I mentioned, we've enjoyed 3 consecutive years, now 4, of double-digit returns. And I think going forward, the realistic expectations is that we're likely to see single-digit returns going forward, still very much positive, but think 7, 8, 9% per year, rather than the high double digits that we've enjoyed for the last several years. And so I'd like to bring in my colleagues and fellow portfolio managers into the discussion. And so, Zach, clearly we've seen that companies directly involved in AI and the data center build out have experienced robust earnings growth, as I mentioned. But how have other areas of the economy been performing?
Thanks, Logan. As you mentioned, we've been fortunate to see very robust returns across the board this year, probably better than any of us expected coming into the year. And yes, given the build out of AI technology and the supporting data center infrastructure, it's no shock that AI companies are performing incredibly well, both in terms of earnings growth and stock market returns. That said, what I'm probably even more excited about is the fact that we're seeing the breadth of the market open up this year, meaning we aren't so reliant on big tech, which has carried the market for several years now. There's no question earnings growth from technology and AI related areas is very, very strong, but participation has expanded across almost every other sector. Tech has seen the highest earnings growth at over 50%, but areas like communication services, materials, consumer discretionary, those are all above 40% as well. So very happy to see those kind of numbers. Economy wide, I'd say, we've seen incredibly strong earnings growth across the S&P 500 with the market wide growth rate at nearly 28%. Now, to put that in context, historically, we see annual earnings growth rates in the mid single digits, say 6 to 9%. So seeing a number like 28% is incredibly strong. And way above estimates coming into the year as well. So we've seen earnings surprise to the upside across the board, with about 70% of the S&P 500 companies beating estimates this year. so far, which has been supportive of the strong market performance we've seen year to date. In fact, we've seen probably the biggest earnings estimates beats coming in consumer discretionary communication services and areas like that. So the market kind of expected those big tech growth rates, but the beats are coming in other areas of the market.
Yeah, that's a
Coming
great
back
point.
to your question about breadth, another way that I kind of like to look at this is looking at the biggest stocks in the market versus everyone else. So we look at what was kind of been deemed the Magnificent Seven: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, which make up a huge part of the index. And they have, like I mentioned earlier, they've led markets higher for several years now relative to the rest of the market. So these large tech stocks, which have become, as I mentioned, the Mag 7, those have produced negative performance year to date collectively. So through the end of June, this group is down almost 2%, while the S&P 500 as a whole is up, as you mentioned, 10% plus. So when you consider the Mag 7 is close to a third of the index, it really highlights how well the rest of the market is performing.
Yeah, that's a great point. And the earnings growth that you mentioned has been nothing short of extraordinary, some of the best that we've ever seen. And you mentioned the changing leadership, increasing breadth in the market. How does that impact equity investors going forward?
Sure. Increasing breadth of performance is an important indicator of market health in general, and an indication of market strength. We like to see a market where all stocks are rising, not just a few outperformers, because the narrow leadership leads to increased risk that those large winners will largely turn over. And we've kind of seen that a little bit this year already, as I mentioned. So that changing market dynamic has produced uneven performance, and it's kind of altered the attractiveness of certain areas of the market, opening up attractive entry points in certain cases. So some of the areas of the market now appear to offer better valuations relative to the earnings growth that I mentioned earlier. Over long periods of time, we generally see that stock prices will track corporate earnings growth over time, but there's always short-term variability to that trend based on short-term market dynamics, which is what we've seen. For example, tech earnings, as I mentioned, up 50%. That produced 45% market returns for technology last year. Meanwhile, you look at consumer discretionary, which grew earnings by 40%, but only produced market returns of 10%. So that gives us some optionality and some more openings into the market to make some good investments. So as active managers here at Florida Trust, we like to look for these dislocations and find market sectors or individual stocks where earnings growth hasn't been appreciated by the market yet, but we believe it will long term. So as long-term investors, we are happy to take advantage of those short-term dislocations. In summary, I'm very encouraged by the strong earnings and the increasing breadth in the market. And I really think it's a great time to be an active manager picking stocks.
Yeah, that's well said. And obviously, we have a heavy emphasis on investing in companies that have the earnings, that have the cash flows to justify their valuations. We think stock selection is more important than ever. You mentioned a sector that I'm interested in, the consumer discretionary sector. How is the overall consumer holding up?
Yeah, the divergence I mentioned in the strong earnings growth from that part of the market and the weaker market performance is likely driven by a perceived weakness in consumer strength. The market basically believing that that is a short-term earnings spike, and that's not going to last. What we're seeing is really that the consumer is strained. There's less propensity for investors to invest in those kind of consumer stocks. However, when we look at the actual raw data, the consumer appears stretched, but not broken in any sense. So spending is becoming a little bit more selective for certain subsets of consumers, but stable overall when you look at the averages. Consumer spending and wage increases have largely been in line with inflation, which is a little bit different than what we've seen over the last decade or so, in that consumers haven't really been growing their purchasing power. They're just kind of staying in line with that inflation number. So it's no secret that inflation has been elevated, and consumers have been absorbing the lagged impact of that inflation and higher financing costs, which is eating up some of the discretionary spending, and certainly depleting savings for consumers in some some segments. On the job front, we have seen, many headlines across the board about layoffs, whether AI related or not, and a tough hiring environment, especially for younger workers coming out of college. So that is tough. But while unemployment is slightly elevated across the board from 2022 and 2023 historical lows, they're still well below long-term averages, and unemployment rate is pretty stable at this point. When we look across the different segments, higher income consumers appear to be somewhat better positioned, while lower and middle income households are more sensitive to the areas where we've seen the most inflation, which have been in food prices, energy prices, and financing costs. So at a high level, some consumers, some segments have become a little bit more strained than we've been used to the last few years, but everything is still functioning. And similar to your early comments, we're cautiously optimistic, but we are watching this area closely.
Yeah, I think you nailed it. There's been quite the divergence in the consumer. The wealth gap is as wide as ever, and it's unfortunate. Lower income consumers are having a very hard time keeping up in this inflationary environment. The silver lining is the higher income consumers have been spending enough to drive corporate earnings and ultimately drive the stock market higher from here. So obviously that's put us into a momentum market over the last couple of years, and investors have been rewarded for riding that momentum, so to speak. And so, Jody, in this momentum market, are you trimming back or staying with the momentum here?
Well, Logan, we've got about 38% of the S&P 500 index invested in just 10 names. That leaves 62% for the remaining 490. And so this creates a concentration risk in these 10 names. We want to continue to own the top performers, but at a more modest weighting to reduce volatility in our client portfolios. When they happen, we want to use market corrections opportunistically. Our objective is to trim positions when they're high and then redeploy that capital both strategically and tactically. Zach alluded to this, but another item to note is that the top 10 performers of today are not the same names that we saw just at the end of 2025. In just 6 months, 2 names have dropped, and we have added Eli Lilly and Micron. And if we look back 10 years, only 2 names have remained the same in the top 10, and that's Apple and Microsoft. So historically, we've seen this rotation, and we expect it to continue. The winners of yesterday are not always the same as the winners of tomorrow.
Yeah, that's really well said, Jody. And, I think position sizing and stock selection matters today more than ever. And that really speaks to our tactical asset management, ensuring that our position sizes are appropriate. And that, again, that we're invested in companies that have those earnings to justify their valuation. Jody, can you talk a little bit about what's been driving the market's momentum and the million-dollar question, whether or not it can continue from here?
Sure, Logan. The revolution in technology that we are seeing that both of you mentioned will take place over time. There will be ebbs and flows in performance, creating volatility in the market. And I believe that we are still in the early stages of truly understanding this momentous impact that both AI and quantum computing are going to have. So, I believe that there is more growth to come, but it will not, this AI revolution will not impact all companies the same or even equally. So our goal is really to maintain balance in our client portfolios and to capture growth, but also to protect the long-term wealth that our clients have achieved. So as you said, we're looking at the underlying fundamentals of the companies that we invest in and really being careful to understand our position size. And, we believe that security selection is very important.
Yeah, that's a great point. And, behind the scenes, we have accommodative monetary policies, accommodative fiscal policies, robust earnings growth. I think we're in the early to middle innings of this AI data center build out. So, relatively favorable backdrop. So, Jody, why caution now when the market seems to be on relatively favorable footing moving forward?
Absolutely. It's simple prudence. Logan, as you know, our founder, Al Hanser, says do the right thing. We always want to do the right thing for our clients, and this is really no different. We have seen multiple years of gains compounding in our client portfolios. Taking some gains is like trimming a tree. We're maintaining the best parts, but also allowing for continued healthy growth. We work with our clients individually to understand whatever their specific circumstances are and to make the best decisions for them and their unique goals.
Yeah, that sums it up perfectly. We are optimistic about where the market is headed from here, but there's certain to be volatility going forward. And after the run that we've had, this is a perfect time to do some rebalancing, ensure that your position sizes are correct, and ensure that the stock selection is appropriate for your portfolio moving forward. We hope you enjoyed today's show. If you have friends or family that you think could benefit from our services, we'd love to make an introduction or simply send out an invite to a future webinar like this. But thank you so much for joining us. We appreciate you. Hope you have a great, relaxing summer, and we'll see you again soon. Thank you.